Hello everyone, it's Dr. Trussell. Welcome to Principles of Accounting, and this is going to be our first chapter lecture. So we're going to just have an introduction to principles of financial accounting. So sit back and relax and enjoy, enjoy, right? And I'll just have this video for the first slide. After that, you'll just hear my voice, but this would be chapter 1. So in chapter 1, we're going to introduce you to financial statements. Financial statements are the reports that normally come out monthly, quarterly, or annually that a company or other entity puts out to understand financially what has happened to the business or the entity during the period. So here are the learning objectives for this first chapter. First of all, we're going to talk about the various forms of business organization. When you start a company, you have to choose a business form. Then we're going to say who are the users and how do they use this accounting information. We're going to explain the 3 principal types of business activity. We're also going to describe the content and the purpose of each of the financial statements. We'll explain the meaning of assets, liabilities, and stockholders' equities, and state what's called the basic accounting equation. And finally, we'll describe the components that supplement the financial statements in an annual report. So in chapter 1, we're going to introduce you to the financial statements. First of all, we'll look at the forms of business organization. And you see there's 3 forms that we're going to talk about: sole proprietorship, partnership, and corporation. Then we'll talk about the various users of the financial statements, and in particular we're going to talk about internal users, those within the company, external users, and then ethics in financial reporting. Then we'll talk about the 3 different types of business activities: financing, investing, and operating. And then finally, we're going to talk about how we communicate with the users using the various financial statements. And we'll talk about the income statement, the retained earnings statement, the balance sheet, and a statement of cash flows. Those are the 4 primary financial statements we'll discuss. Then we'll talk about how they're interrelated, and then what other items go on an annual report. A company every period puts together an annual report that has all of those financial statements and other things. So let's first talk about the 3 different forms of business organization. We have a sole proprietorship. Let me back up a second. You're starting a company. You decide to go in business on your own. And you have to, very first thing, decide what form do you want that business to take on. If you're by yourself, let's say that you're starting a landscaping company, then you could be a sole proprietorship. It's very simple to establish. You have complete control over it, and there's certain advantages that are relate to it, primarily being that you pay tax just as a sole proprietor, not as the business. Well, what if you have more than one person starting the company? Then you can go to a partnership. Again, still very simple to establish. You have shared control between you and the other partners. You have a broader skills and resources because you're more than one person, and you still have some similar tax advantages as a sole proprietor. And then finally, there's a corporation. It's easy to transfer ownership. For example, if I'm in a company and I want to get out, I can easily transfer my ownership, where a partnership is a little more difficult. It's very easy to raise funds because besides borrowing money from a bank, you can issue stock and such, and you have no individual or personal liability. If the company goes under, if it gets sued, they can't come after your personal assets where they can in these other types of organizations. So very first thing, you're starting a business, which type of form are you going to choose? In choosing the organizational form for your outdoor guide service, you should consider the pros and cons of each. In other words, each of those three forms. Identify each of the following organizational characteristics with the organizational form or forms with which it is associated. Which one is easier to raise funds? You're trying to get money, you're trying to raise cash. Which one is easier? Well, the corporation is the easier of the three. Which one are simple to establish? Well, both the sole proprietorship and the partnership are very simple to establish. Which one has no personal legal liability? The corporation. That is, they can't come after your personal assets. And which one has tax advantages? Both the sole proprietorship and the partnership. And which one is easiest to transfer ownership? That would be the corporation. So you get the idea that there are different types, there are pros and cons when you go to choose. Most people think there's a trade-off between the tax advantages that you'd have of a sole proprietorship or partnership versus the legal liability that you have on those. And so it might go towards a corporate form, but then you pay double taxes. You pay tax at the corporate level and you pay at the individual level. Let's talk about the users and the uses of financial information. First of all, we have what's called internal users. Internal users, that means company users of the financial information inside the company. So you put together, as an accountant, you put together all of this financial information, all this information about the cash and such coming in and going out of the company. What do people inside the company, how do they use that information? Well, first of all, the finance department is going to use it because they want to know whether or not you have cash sufficient to pay dividends, for example, to your stockholders. Stockholders are the owners of the company, of a corporation. The marketing department, well, the marketing department might try to use the information to determine what price should they charge for an iPod. Well, pricing is you have to know how much it costs to figure out how much you should charge a customer. Where do you get that information? From the accounting system. And then management of the company will, which PepsiCo product line is most profitable? Are they making more on their snack chips, which would be like Lay's potato chips, or their beverages, which would be Pepsi, for example? And should they eliminate any of the product lines? And then you have human resources. Can General Motors afford to give employees pay raises this year? Or can they give their executives a bonus this year? It depends on what the financial information, what the financial status of the company is. Here's just a case study on financial information within the company. Take a look at the question down here. What are the benefits to the company and the employees of making financial statements available to all employees? Well, you can get a chance, you can read the scenario there, but the gist of it is this. As an employee, you need to understand what your compensation package is, how are you going to determine your salary and your wages, and maybe if you work for a union, the union needs to know what kind of profits are being made, and is there ability to cut a new deal with the unions and the employees with the company. So there's lots of uses of financial information by the employees. Well, let's talk about external users. Now, external users are users outside of the company. They don't work for the company, they're outside the company. Well, the two biggest groups are investors, you see over here, and creditors, you see over here. Okay, investors are the owners of the company. And so we would like to know if they're making profits or not. Or the creditors are the ones who loan money to the company. and they're concerned with getting their loans paid off when they come due. Again, we have another case scenario here. How will the study of accounting help you? A lot of people wonder, why am I taking accounting? Maybe you're not an accounting major. Why are you taking this course? But like it says here, a working knowledge of accounting is desirable for virtually every field of business and even some fields outside of business. So, for example, if you're in general management, you need to understand accounting data in order to make good business decisions. If you're in marketing, we need to know what prices should we set. What are the costs if we're making money on a certain product? If you're in finance, you need to know how are you going to raise money and how can you pay the bills, etc. So various different fields all rely on accounting. Accounting is sometimes called the language of business because you can't understand business without understanding accounting. Accounting crosses all disciplines within the field of business. Well, we have to have ethics in financial reporting. United States regulators and lawmakers were very concerned that the economy would suffer if investors lost confidence in corporate accounting because of unethical financial reporting. And there is lots of recent financial scandals. Well, they say recent now. Enron has been 16 years or 17 years ago now. So was WorldCom and such. But these scandals really rocked the economy. And so what Congress did is passed a new law called the Sarbanes-Oxley Act in 2002, and that basically required lots of new reporting that all companies do. But the key is you have to have integrity when you issue the financial reports. And there's a process of solving an ethical dilemma. Sometimes you're involved in a dilemma when you get out into the workforce and you have to figure out, what am I going to do? First of all, you need to, step one is recognize an ethical situation and the ethical issues involved. So you need to know whether you're in a situation, if your boss tells you to do something and you think to yourself, this doesn't feel right. So that's the kind of situation we're talking about. I don't think we should be doing that. And so then after that, if you identify the situation, the second thing you do is identify and analyze the principal elements in the situation. That would be what we call the stakeholders. Those are the persons or groups who may be harmed or benefited. Then you ask the question, what are the responsibilities and obligations of the party involved? Okay, so once you identify the situation, who are the stakeholders? How could they be harmed? How can they be benefited? Why is this my boss telling me to do this thing? What's the benefit that he or she may get? And then finally, identify the alternatives and weigh the impact of each alternative on the various stakeholders. So for example, you have this dilemma. Your boss tells you to do something, you don't think it's right, so you identify all the stakeholders and then you think, what can I possibly do? I can, for example, go to my boss's boss, or I might even go to the place where I say I can't work for this company anymore. Point is, you have a process that you go through. And this just is a little case here talking about nonprofit organizations, those or charities. And you think, well, what do they have to do? What does that have to do with ethics? Well, remember that charities receive a lot of donations from people, and if I donate some money to a company, I have to trust that they're properly using those funds. So ethics is very important in the nonprofit sector too. So a review question, which of the following did not result from the Sarbanes-Oxley Oxley Act. A, top management must now certify the accuracy of financial information. That is true. That's a new thing underneath the Sarbanes-Oxley Act. Sometimes that act is called SOX because Sarbanes-Oxley, and so we just refer to it as SOX. And so SOX requires that we certify the accuracy of the financial information. And penalties for fraudulent activity increase. That is true. If you commit fraud, the penalties are higher, including potential jail time now. Independence of auditors increased. Well, that's also true. Auditors are the companies, the external companies that come into a business and make sure the financial statements are reported correctly. And then finally, tax rates on corporations increase. That is not true. So the answer is D. All right, what are we talking about? Business activities. All businesses are involved in three types of activity: financing, investing, and operating. We'll talk about each one of those in turn. The accounting information system keeps track of the results of each of these business activities. So the information system, it could be a computer system or otherwise, it's a method of keeping track of all of the activities that a company's involved in. Financing activities, basically talking about how you raise capital. How does a company get its funds, its outside funds? Well, they do it really in two ways. They can borrow money, which we call debt financing. The debt is something that you owe. It's also called a liability. So if you borrow money from a bank, then you have what's called a liability, but you're getting cash. That's a source of financing. Party to whom the amounts are owed are called creditors. So the banks, for example, are creditors. Notes payable and bonds payables are different types of liabilities, and we'll get into that later. The other primary source of outside funds is issuing, or what they call selling, shares of stock for cash. And that means you have stockholders, and those stockholders give you money in exchange for cash. And then when we pay money back to them, it's called a dividend. Investing activities are purchase of resources a company needs to operate. So now you've raised capital. Let's say you're starting a business. You raise funds by borrowing money from a bank or selling stock to stockholders. What are you going to do with that money? You're going to invest it. And you can invest it in, say, computers, delivery trucks, furniture, buildings, land, etc., all of which are called property, plant, and equipment. And the resources that you own, that is the property, plant, and equipment, your trucks, furniture, buildings, etc., all those resources we call assets. Those are things that you own that you use in the business. And investments like stocks and bonds, investments are another example of an investing activity. And finally, and operating activities. Once a business has the assets it needs, so it has the furniture, the fixtures, the inventory, etc., you can start operations. And the operations would include revenues, which are the amounts that you earn from selling products or providing a service. So you have sales revenue, service revenue, interest revenue. This is the amount that's earned. So when you sell a product, we call it sales revenue. If you provide a service like lawn mowing or something like that, that's called a service revenue. Inventory are the goods available for sale. So if you own a sporting goods store, all those goods, the basketballs and tennis shoes and shirts and everything else, we call that inventory. And accounts receivable is the right to receive money from a customer as the result of a sale. You go into a store, and instead of buying something for cash, you use a credit card. That is what we call an accounts receivable, because we made the sale, the company made the sale, and they have the right to collect the money from that sale. Other examples of operating activities are expenses. Well, those are cost of assets consumed or services used. For example, how can you, if you have a coffee shop and you sell coffee, okay, that's your revenue, sales revenues of coffee, but it cost you, you had to buy the coffee. That's what we call cost of goods sold. And you had other expenses like rent and utilities. Those are all cost of assets consumed or services used. We already talked about liabilities. Those are things that you owe. Arising from expenses includes accounts payable, that when you buy something from your supplier, interest payable, wages payable when you owe the your employees, that'd be wages payable, etc. And then net income is when you take your revenues and subtract out your expenses, and revenues are greater than expenses, we call that net income. It's also called a profit. So another word for net income is a profit. Sorry, I'm writing with a mouse. It's not that easy. And then if expenses exceed revenues, that's called a loss. That means you didn't sell enough to cover your cost. That is a loss. All right, classify each item as an asset, liability, common stock, revenue, or expense. Those, by the way, are the 4 different categories of accounts. Right there. Sorry, I said 4. The 5 different categories of accounts. And the sooner you understand those different categories, the easier your life is going to be in this class. So cost of renting property. Well, that's going to be an expense. So paying the rent is expense of doing business. A truck purchased. Remember, that's a resource, and resources are assets or things that you own. Notes payable. Well, that's when you borrow money from a bank and you have to pay it back. That is a debt, or what we call liability. Issuance of ownership shares, or stock. When you issue stock in exchange for cash, that's called common stock, which is also called stockholders' equity. And then amount earned from providing a service. So you're an attorney, you provide legal services, that kind of thing. That is called a revenue. And then amount owed to suppliers. What is that? Oh, that key word there is owed. So you owe money. That is a debt or a liability. Again, if you can get those classifications down, it'll make your life a lot easier. All right, so now we have that accounting system. We come to the end of the period and we're ready to communicate with our users, our investors, our creditors, our employees, etc. We're ready to communicate with them. We have what are called 4 financial statements, different statements that we prepare to give to our users. And we're going to deal with all 4 of them, but they're called the income statement, retained earnings statement, balance sheet, statement of cash flows. All right, so net income will result during a time period when? Well, net income, remember, it's profits. When do you have a profit? If you sell more than the cost, which is revenues exceed expenses, you will have net income. You will have a net, they didn't ask that, but if you have expenses exceeding revenues, then that's a loss. Let's talk about the income statement. Though the income statement is the difference between revenues and expenses. So it reports revenue for a specific period of time. Notice, for example, it says for the month ended October 31st, 2014. So for 1 month, what were my profits? For 1 month, what were my revenues? What were my expenses? So if revenues exceed expenses, you'll have a net income. If expenses exceed revenues, you'll have a net loss. And why do we care about that? Because companies users are going to use your net income to help predict future net income. So what we have, revenues. So let's say you are a law firm. Your service revenue will be your legal services. And then your expenses of operating the company. You had to pay salary, you had to pay rent, you had to have supplies, etc. Those are all of your expenses, and then we take our revenues and subtract out expenses to get net income. Now, looking at the retained earnings statement, the retained earnings are profits that are kept in the company. So when you earn a profit, you can either keep them in the company or you can pay them out back to your stockholders. And those are called dividends. So this is how these two statements are related. And the net income for the year is going to increase our retained earnings because that's money kept in the company. But if you take some money and pay it out to your stockholders, and that's called dividends, so that's why they are subtracted out. And that gives you, at the end of the month, how much of your net income was kept in the company. So your retained earnings shows the causes of changes in retained earnings, which we know is primarily net income and dividends. The time period is the same, covered by the income statement. It's month of October 31st. And users can evaluate dividend payment practices. They want to know how much of your net income you actually paid out to the stockholders. The balance sheet is very important also. It shows all of your assets. Now remember, we said assets are things that you own. They're the resources of the company. For example, you own cash, you own equipment, you own supplies, etc. And then we have the liabilities, and the liabilities are things that you owe. So you owe the bank, that's a note payable. You owe your suppliers, that's accounts payable. And then the other category is stockholders' equity. This is what the investors have, or your stockholders, your investors, what they have put into the company. And notice that your retained earnings statements that we did in the previous slide, that retained earnings number comes down to your balance sheet. So they're all kind of interconnected. That's the same number there. And then another thing to notice is that assets right here equal, let me get a different color here. Assets equals liabilities plus stockholders' equity. You see how if I take my liabilities and add in my stockholders' equity, it's going to be the same number as the asset account up here. And that's driving home the point here. Assets equals liabilities plus stockholders' equity. And assets are listed first, and then their liabilities, and then your stockholders' equity. That's the format of the balance sheet. And then finally, we have what's called the statement of cash flows. The statement of cash flows shows how cash flows in and out of the company. And remember, we talked about those three categories of business activities: operating, investing, and financing. So we say where they got cash and how they spent cash by the three types of activities. For example, operating activities, we had cash receipts, which would be, for example, cash sales and that type of thing. Now, each of these things we're going to talk about in great deal in the next few chapters. This is just an overview. So if right now, if you're kind of freaking out a little bit, that's understandable. A lot of information is coming at you. But in this chapter and the next chapter, we'll keep showing you more about this. So the statement of cash flows tells you where did we get cash during the period? How do we spend our cash? And what was the change in our cash during the period? So Where we got cash from operations. We paid cash. A negative here is brackets are normally used as a negative. We spent cash on investing activities, and we got cash from financing activities. And our change during the year, by adding these three numbers together, will give you this change. Which of the following financial statement is prepared on a specific date? Well, there's only one. The income statement, the retained earnings statement, and the cash flow statement is for a particular period, be a month, quarter, or year. Only the balance sheet is at one point in time, normally the end of a period, say December 31st, 2016. So beyond the financial statements, we talked about these four reports, and they're basically talking about finances or the economics of a company. But also, you might be more thinking about things like ecological or social performance, not just the financial reports, but what's going on, what's their impact on society, or what's their impact on not just the economy, but on the ecological impact, and that is the environment. Well, our basic financial statements don't show that, but they have other reports. That some big companies have other reports that they put out that also talks about environmental issues and social issues. And so you can see that they call them sustainability reports, sustainability, and those exist also, but they're not part of the typical annual report. Companies that are publicly traded must provide shareholders with an annual report. Now, what do we mean by publicly traded? That means that the stock, you and I can buy the stock. It's available to the general public, as opposed to a privately held company means that you and I cannot buy the stock in those companies. So publicly traded have to provide an annual report every year, and they have to make it available to the public. And what does the annual report include? Well, those four financial statements we just talked about, what's called the Management Discussion Analysis, or MD&A, and the notes to the financial statements and the auditor's report. We'll talk about each one of those as we go through here. Management Discussion Analysis, part of the annual report, is basically instead of numbers, I mean there are numbers in there, but it's more of an explanation. So the management, I'm talking about the chief financial officer, chief executive officers, controllers, etc., they have to discuss in words what happened during the year. So they have to highlight favorable or unfavorable trends and significant events and uncertainties that affect during the period. So it's normally several pages long of discussion from management. Here's just an example, and this is just a very small piece from the Tootsie Roll company. Who loves Tootsie Rolls out there? Just one example. It's notice that it's very descriptive. It's not like a numerical report. Again, they can't have numbers in there, but it's more descriptive. Then the notes. The notes to the statements are like footnotes, if you will, but they're required. They're required in that annual report. They help to clarify the financial statements and provide additional detail. So here again, here's one from Tootsie Roll, just one. They're normally again several pages long, where they describe how a company recognizes or determines its revenue. The auditor's report. The auditor is an external party. Normally they work for a CPA firm, which is Certified Public Accountant. they work for a CPA firm, and the CPA firm is hired by the company to come in and make sure the financial statements are fair, make sure that they are being reported the way they're supposed to be reported. And they give a report, and so they're going to give you their opinion on whether they're prepared properly or not. So for example, in here they say that they are presented fairly, and that's an annual report. That's again not from the company, that's from somebody outside the company, a CPA firm, certified public accountant. All right, state whether each of the following items is most closely associated with management discussion analysis, the notes to the statements, or the auditor's report. Descriptions of significant accounting policies. Well, that falls in the notes to the statements. An unqualified opinion. Remember, we said an opinion is what the auditors will give at the end of the year. Explanations of uncertainties and contingencies. Well, that's going to come out of the notes to the statements. Description of ability to fund operations and expansion. That's going to be in your MD&A. Description of results and operations, also in your MD&A. And a certified public accountant or CPA, they're the ones who prepare the auditor's report. International accounting standards are referred to as International Financial Reporting Standards, better known as IFRS or IFRS. They are developed by International Accounting Standards Board, or the IASB. Over 115 countries require or permit the use of these standards. Those standards are different than they use in the United States. So the United States has what's called Generally Accepted Accounting Principles, or GAAP. Those are different from the IFRS standards, but they're similar in a lot of ways. But just to let you know, there are some differences. Which is the following is not a reason why a single set of high quality international accounting standards would be beneficial. Well, it would be beneficial if there were mergers or acquisitions, that is one company buying another. It's good to have similar standards, that everybody's following the same rules. The financial markets or the stock markets would also be helpful to have standards, those standards. And of course, multinational or international corporations, if you're using the same standards, it's easier to compare. Now, what we said was generally accepted accounting principles, or GAAP, generally accepted accounting principles, is widely considered to be a superior reporting system. Well, that's not necessarily true. The two systems between the U.S. GAAP, that's what we use in the United States, is this GAAP, and as opposed to the IFRS statements we talked about earlier, and they're very similar in nature. So one is not necessarily superior to the other. In the Sarbanes-Oxley Act, remember we called that the SOX, the Sarbanes-Oxley, determines what? It does not determine, it has nothing to do with tax regulations, but it does have to do with internal control standards, but it's not related to the IASB. It's internal control standards, but for U.S. publicly traded companies, and has nothing to do with tax. So therefore, the answer is C. Notice B and C are very similar, the difference being that it is for U.S. companies as opposed to, remember, the IASB is international companies. That's what the I is for. So that's how we got down to C. IFRS practice. IFRS is considered to be more what? Well, they have what's called principles-based and rules-based. Principles-based means that they're more conceptual. They have these broad concepts that they follow, as opposed to rules-based, which means very specific guidelines on how to prepare your financial statements. And IFRS is considered to be more principles-based than rules-based, where US GAAP is considered to be more rules based. So this B would be true for the US GAAP. And it's definitely not more detailed than GAAP, because actually US GAAP is more detailed. And that takes us to the end of chapter 1. A lot of information, but this is just an introduction. As we go forward to chapters 2 and 3 particularly, you're going to get more of the same kind of thing.